If you are an advisor and you happen to be in an office with other advisors, or you're not an advisor but have some people around you, let them know that this is happening. I think it's going to be a good conversation between me and the founder of GraniteShares, Mr. Will Rhind, talking about a topic which is always near and dear to most people's hearts, which is getting more income, especially in a world where yields are questionable in terms of where they're going, and in a world where taxes, depending upon which state you're in, may be going up. That's a little hint given our backgrounds here as far as where Will and I are based out of. For those that are here for the CE credits, I will email you afterwards to get your information. I'll submit that to the CFP board. Just stay to the end of the discussion here. If any of you want to ask questions during this roughly half an hour conversation, put it in the chat, put in the Q&A. We'll bring it up. We'll make this as interactive as possible. So with that said, my name is Michael Gaia, publisher of the Lead Lag Report and founder of Lead Lag Media. Joining here is Mr. Will Rhind of GraniteShares. I feel like Will, some people may not be familiar with the GraniteShares, but they should be, given that you're at 13 billion, I think now, in AUM. So give a little context as far as the firm and what you guys do.
Yeah, sure. So morning, everybody. Will Rhind, founder and CEO of GraniteShares. We're an ETF issuer based here in New York City. We issue also some different types of ETFs, but as Michael said, we're about 13 billion in assets under management. And we have an array of strategies here in the United States, in Europe, and in Asia as well. Probably the two things that we're most well known for are leveraged single stocks. So on a day like today, when everyone's voting on Elon Musk's $1 trillion pay package, and there'll be a lot of activity, I'm sure, in our 2X long and short Tesla ETFs, so TSLR and TSDD. Leveraged single stocks are a hugely popular product category. And then we have our YieldBoost ETFs, which are, as the name might imply, very high yielding ETFs, typically around 50 to 150% per annum. These are ETFs that use options to generate these very high yields, and something that has just become a hugely popular asset class in today's world.
We're definitely going to touch on YieldBoost, but let's just talk big picture for a second here. Everyone was convinced that we're going to have a series of multiple rate cuts, and here comes Powell basically putting some cold water on that thought. It's not a foregone conclusion, I think was the quote. I know as an ETF issuer, you're not necessarily out there making calls on monetary policy, but I'm curious to hear your thoughts on where you think rates might be going, because that will impact the discussion around yielding ideas.
Well, rates are going down. I think the question really is how fast and to what particular level. And irrespective of the kind of end, let's call it the end of the Powell era, and where we get to before Powell steps down, a new chair is appointed, but rates are on the way down. I think it's clearly a huge point for the new chairperson to get rates down. Clearly, the administration wants rates way lower than where they are just now. So whether we get another cut before end of year, I think most likely yes. But the government shutdown, I guess, as long as that goes on, creates some uncertainty, and perhaps some of the committee members can have pause there. But rates are coming down, and that's really the crux of this conversation as to why people are looking for higher yielding assets.
Maybe like 5-6 years ago, I used to always say, when we were in zero interest rate policy, they want yield when there is none. Now they don't want yield when there is some. I'd now add a third layer to that, but the yield they want is really high yield, right? Talk us through a little bit, sort of from your vantage point, the way demand has shifted in terms of looking for higher yielding instruments outside of bonds.
I mean, I think that there's clearly not one answer to explain all of this. It's a it's a broad church in terms of people's needs and wants, but ultimately, I think what's going on when it comes to the high yield, at least the space that we traffic in, is the rates that people are getting in the bond market are just not high enough when you take into account inflation. Now, I'm not necessarily talking about the official CPI number, although when you take that into account, it clearly does detract significantly from the sort of rates in markets, but the unofficial sort of inflation numbers. And, there's a growing movement of people, I think, that are looking to create a independent source of income outside of their job. And, perhaps this is about, on one level, just financial freedom, being able to sleep at night. Perhaps another level, it's prudence in terms of creating a secondary source that provides a backstop if you were to lose your job. Particularly, people are nervous about AI and just the economy more broadly when it comes to job security at this time. And so the idea of creating an independent source of passive income, I think, is very appealing to a large section of the investor class today, and that's growing, at a very significant rate. I mean, I think the flows into options-based income ETFs are really quite staggering. And again, I think that sort of narrative explains, at least in part, what's going on. I think you throw in the volatility of the bond market and how bond portfolios let people down, particularly, in the Fed easing cycle, the Fed rate hike cycle. And, perhaps the fact that bonds were not the safe haven that, people were sold that they were. You add that into mix, and I think it's people saying, well, if bonds aren't as safe as they were, then, the risk part I'm sort of more okay with. I'm just looking for higher yields, and I want consistency of income.
I wonder how much of that is just a shift in trust. Like, investors don't trust bond issuers because the Fed will step in and inflate it away, and certainly doesn't trust U.S. Treasuries, right? As we've seen, given the way duration has acted, versus trusting private enterprise. I mean, is there maybe a shifting the way people just think about where they should trust their capital?
I think when it comes to Treasuries, at least in money markets, it's not a trust issue in my book. I think investors have no problem parking money in Treasuries or money market funds, and it's not about trust. It's about pure risk reward. And clearly, with rates coming down, there's a huge amount of money that's sitting in Treasuries and money market funds at the moment, trillions and trillions of dollars. And, that was all fair and good when, rates were 5%. But if we're going to a level, significantly lower than 5% and a rate again, that after inflation rates actually go negative again, or at least are negligible, then there's an argument that where does that capital go? And a lot of that capital is going to come off the sidelines, go out of these funds, whether it's Treasuries or money markets, and into risk-bearing assets. So some of those will clearly go into higher yielding elements of the bond market, but a lot will go into equities, or go into alternative sources of income like options-based income ETFs. And so that's, I think, more the case that as rates come down, you'll see a lot of that money in motion, and that money is going to find its way into more productive areas of the ecosystem, be it just straight equities or dividend equities or something like the options-based income ETFs.
So you hit on that point that I think you used the word staggering in terms of the demand for some of these options income strategies. Let's go basic for the audience and explain how you generate income from options, but then after that go deeper, because there's a lot of different ways of doing that.
So at its simplest point, when you sell anything, that you get something in return. And what you get for that is called a premium. And that can be distributed out to shareholders in the form of income. So you have specific option strategies where you sell an option on an underlying asset that generates an amount of cash. You distribute that cash to shareholders, and that's your distribution or your income or your yield, whichever way you like to look at it. So it is simplest level. That's what's going on. And you sell options on underlying assets. That could be stocks, that could be ETFs. But this is a very, very sort of liquid and growing market that enables you to generate yield from an underlying asset, be it a stock or an ETF. So I think it's fair to say that the majority of these strategies are, like you said, a covered call strategy. And that means, in its sort of simplistic term, that you own the underlying asset, be it a stock or be it an ETF. and you sell a call option on that underlying asset. And so by doing that, you receive a premium for that. That caps your upside to that underlying ETF or stock in the form of the premium you receive, but you are still exposed 100% to the downside of the movement in price of that underlying asset. So that's a very popular strategy for people that, again, looking for yield. So what YieldBoost does is a different version of that, slightly more efficient version of that in our view, where instead of selling a call option, we sell a put option. So that's a bit more efficient in our book. And then simultaneously, we buy a put option. So we complete the income generation part of the spread, which is selling that put option to generate income, but we simultaneously buy a put option, which provides some downside protection. So that's called a put spread strategy, where you're selling one option, you're buying another, and then you're capturing the exposure within that spread.
So I think this is actually incredibly important because in most investors' minds, they tend to separate yield from the underlying value of the asset. Right. So I remember in 2008, a lot of managers got in trouble because they said, well, it's money good because I'm still getting my yield. And then the underlying asset blew up. Right. In the case of YieldBoost, you are having some insurance protection with that put that you're buying, which is what these cover call strategies do not have.
Exactly. So in simple terms, it's a design improvement. It allows for that element, which of course is designed to provide some protection against the obvious weakness of covered calls, which is the income is nice typically, but you're giving 100% exposure to the downside.
So is it fair to say that over a long enough market cycle, that type of approach would have better risk-adjusted total return than a cover call only strategy?
It's always difficult to say in generality, but yes. I mean, typically what we find is when we observe periods of actual realized volatility, in some cases, the realized volatility of the YieldBoost strategy is lower than the actual underlying, let's say it's Tesla, for example. Then although YieldBoost generates such high yields, we sell options on underlying leveraged ETFs. That's the way that we're able to generate the kind of yields that you see. And while leveraged ETFs are volatile, when you put it within the confines of the put spread strategy, the actual realized volatility numbers can be even lower sometimes than the stock itself. So again, depends on the period of time you measure, but that spread, because it's a defined outcome, can limit risk sometimes less than the actual underlying itself, ultimate underlying.
So what some of the individual YieldBoost funds for a second here, because the distribution rates are pretty eye-popping. I mean, here's AMYY, which is on AMD, 100% plus distribution rate. I know you do the announcements weekly, usually on Wednesdays. How are you getting those rates that high?
Well, I mean, the secret is that if you take a stock like AMD, there will be a very liquid options market on AMD. So if you just sell an option on AMD, you receive a premium, and that premium, the value of that is derived from its what we call implied volatility, which is a number. So let's, for argument's sake, say the implied volatility is 60 in the market. Well, if you sell exactly the same option on a 2 times leveraged AMD ETF, then all things being equal, the premium that you receive will be 2 times that of the unlevered underlying. So instead of 60, it would be 120. And so automatically you're capturing 2 times the premium as if you sold an option on the stock. So when you capture 2 times the premium, that's 2 times the amount of income that you can distribute out to shareholders. And because you're capturing so much premium, then we use some of that premium to buy downside protection. And that's effectively the strategy. So it comes from selling options on the underlying, but if you sell options on a leveraged underlying, then you can generate 2 times the premium if it's a 2 times ETF, or 3 times the premium if it's a 3 times ETF.
Is it fair to say, again, speaking about generalities, that when you're looking at the options market in the levered space, there's a lot more inefficiency? So the premiums are more mispriced, which is the benefit.
I'm not sure whether it's inefficiency, because at the end of the day, it's an instrument that can be arbitraged. So if there's a mispricing, people will arbitrage that difference. I think it might be fair to say that in some cases there's less liquidity, or the options market is less developed than the equivalent for, let's say, an underlying stock. And in that case, the benefit of doing something like a yield boost strategy is by using bespoke options contracts that are negotiated directly with brokers to generate premium, as opposed to just being limited to trading listed options. So there's more flexibility that we have as an active manager within that space. But ultimately, to the extent that there's a mispricing, it's not in the sort of traditional sense. It's more an arbitrage opportunity for people.
You hear this term often, NAV erosion. I know one of your competitor fund families is getting a lot of heat for some of the things that's happening on that end. Tide is maybe turning on some of these types of products that are not as thoughtfully designed, I think, as the yield boost strategy is. Let's talk about what NAV erosion is, and maybe why investors are underestimating the potential of it in a more normal market, which isn't just going up the way it's been going up.
I mean, it's just a catchphrase, if you will, for what we talked about with covered calls. So it's something that is very much synonymous with covered call ETFs, and again, just simply goes to the fact that you're capturing the premium, but you're capturing all the downside. So when you sell effectively the upside away, you get a premium for that, but in return, the exposure is 100% to the downside. So therefore, if the underlying goes down, then the value of that ETF goes down, aka the NAV goes down. That's what people are talking about specifically when they talk about NAV erosion. So it's really just something that is present with any strategy where you don't have a downside protection with options, but particularly with covered calls.
Okay, so as far as the fund suite, you've been at a torrid pace of launches, right, on single stocks. Let's talk about the fund lineup currently, and then I want to touch on the broad-based averages, the Qs, the S&P type yield boost plays there.
Yeah, I mean, we've really expanded quite significantly the offering for yield boost. So I think we're up to 14 or 16 funds now. And it was only a few weeks ago, it felt like we were just adding the 10th fund. So the range is expanding quite significantly. We've just added new funds to the lineup, including Mara, a yield boost Mara, yield boost IonQ, yield boost SMCI, yield boost MSTR, and others. So the range is really expanding quite significantly. And I would say that what's interesting is, all of these have different sort of yield profiles. And so the more volatile the underlying, typically the more yield that is able to be generated. So you might have something like a Coinbase, yield boost Coinbase, which is generating around 150% per annum. And then you have a newcomer like yield boost Mara or yield boost IonQ, which is also up around that 150% level. And then you have something more diversified, like you said, like the yield boost SPY, yield boost triple Q, and those are around the 50% level. So a lot less yield, but more diversified than the single underlyings.
The largest one of the fund family is the Tesla one, TSYY. You can see that on the bottom of the screen. And then the others obviously are getting some good traction. Maybe just for those that are curious about the newer ones like the Meta and MSTR, the smaller ones in AUM, talk about liquidity. If there's concerns that investors should have when they look at smaller funds on AUM.
I mean, I think there's always an element of people looking at the number of shares that are traded on the screen and having concerns about a fund that has light volume as opposed to a fund that has really significant volume. I think the thing to always remember is with ETFs, that is, ETFs are open-ended. So that means we can manufacture shares on demand. So in other words, if you see, let's say a very, very small amount of shares trading on the exchange, you might see an average daily volume of say 1,000 shares. Somebody wants to put an order in for 10,000 shares. Then it's not like a stock where that order can't be completed or would have to be worked in over several days. it goes to the market maker who would come to us. We create more shares, or they would technically create more shares, and then use those to sell to the customer that's looking to buy 10,000. So the supply and demand of these ETFs expands and contracts accordingly. So when you see an ETF that's small, don't ever make the mistake of thinking that that doesn't equal liquidity, because with ETFs, they're able to expand and contract. And I think that's kind of goes back to the very dawn of ETFs. And, we're still talking about it to this day, that the trading volume does not equal the liquidity when it comes to ETFs.
The thing about your product suite is that there's a product for pretty much anyone and everyone, right? So there will be some that are listening to this that may not be super into YieldBoost. A lot of people will be into YieldBoost, but again, I'm still looking for high income. You have more than just YieldBoost, so I want to touch on HIPS here because I think this is really interesting, fun, good history. We should
Yeah. So HIPS is another high income ETF, but it's not a bond ETF. And when we say high income, we just mean something that would, by all traditional metrics, be high yielding. So HIPS is around 10% per annum. And HIPS invests in pass-through securities. So pass-through securities are a section of the market where you have REITs, you have closed-end funds, you have BDCs and MLPs. All of these different securities, they all have in common the fact that they don't pay corporation taxes. So they distribute by law substantially all of their income to shareholders. So they're a good asset for those people looking for income and consistency of income. So HIPS is an interesting product because it's designed to produce income. But what I think is different about HIPS is not only that it has exposure to those four underlying asset classes within the pass-through security world, but it pays a fixed cash distribution of 10.75 cents per share per month. So that means that when you buy it, you're effectively locking into the yield at that time, which can be attractive to a lot of people who are looking to budget a certain yield number or add a certain yield number to their portfolios. So HIPS is an interesting asset class. And I think it's almost especially interesting today because the performance of HIPS this year hasn't been that great. And the reason for that is all the concerns in the market around private credit. Now, HIPS, of course, doesn't hold private credit, but it holds BDCs, which can have exposure to private credit. And I think it's just a reminder that with First Brands and the bankruptcies that we're starting to see in the private credit world, this was an area of the market where, funds like HIPS would have traditionally competed with or do compete with. And, people were getting similar yields to HIPS, but in a private credit, from a private credit structure. And one of the advantages that was always claimed was that you didn't have a mark-to-market NAV. And therefore it was easy to say, okay, well, I'm getting 10% and I don't have volatility in my NAV. Well, of course, that's not true. It just meant that you didn't have a daily mark-to-market NAV as with any public security. And I think now what we're seeing is just a lot of interest in the public version of things like HIPS, where people are really starting to worry about private credit and worry about the exposures that are hidden in some of those funds, knowing that they're locked up. So I think, again, the cycle is coming back to the value of liquid, transparent securities that people can get in and out, whenever they choose, not whenever the manager chooses.
I was going to say, what's interesting about that, and I've talked about private credit myself on the Lead Lag Report side. I was reminded the other day that in 2008 during GFC, we obviously saw a bunch of banks go under, but there was like maybe only one BDC that went under, right? Now, obviously, apples and oranges, much bigger market now, but the concerns around mess, the sort of throwing the baby out with the bathwater type of thing, it probably is not going to be that type of dynamic at all here, right? I mean, you're not going to have the kind of widespread defaults because there's a lot more transparency when it comes to BDCs in general than a lot of people realize.
Well, I mean, I think it's too early to say because BDCs have investments or have exposure to all sorts of companies. And the fear is with the private credit market more broadly, that you had bankruptcies that occurred seemingly out of nowhere, that has affected very big banks, very sophisticated lenders who purportedly should have known better. But without going into the specifics of those particular transactions, the general fear, if you want to make the GFC kind of analogy, is that like with mortgage-backed securities, private credit started as a genuine high quality asset class where managers would find deals of good quality with good terms, good quality lenders, and offer those within specific funds. What happened is that it almost became a victim of its own success, whereby you had tons of capital flowing in, and as capital kept coming in, then managers had to deploy that capital to more and more deals. And I think the concern has been that the quality of those deals therefore deteriorated over time because just aren't that many high quality deals in the market. So long story short, clearly it's way too early to sort of claim anything more than just an era of or a notion of suspicion and or of concern with this. But this is what you're seeing manifesting at the moment in some of the BDC market, is that while these companies are not private credit direct themselves per se, but clearly have exposure to that sector.
Yeah, and look, I mean, to the extent that investors are overreacting to it, it's a buying opportunity. I think that's over the key to this. Final thoughts here, Will, for those that are looking to put together a portfolio of income ideas, not investment recommendations here, but what do you typically see? Mixture of some yield boosts, mixture of some bonds, some HIPs, some preferreds. Like, how should one think about creating a real diversified, robust portfolio from a yield perspective?
Yeah, I mean, I think if you want to think about it from the pure yield perspective, then there's never been a better time to be an investor in the yield space. You have a huge amount of products, and you have very, very precision tools that you can use within your portfolio. So if you're looking purely for yield, you can dial that up or down seemingly as much as you want. If you use products, say on the YieldBoost side, you can dial up that yield, very significantly. If you're looking for, preservation of capital, then clearly there are instruments that enable you to do that on the money market side, treasury side, that will do that, but offer you minimal amount of yield in return. So I think the basic use case for a HIPS, for YieldBoost, for anything that generates, let's call them high yields, is more about risk-adjusted returns in a portfolio. So put simply, you can use instruments like this to increase the amount of risk, increase the amount of yield, I should say, in a portfolio, and marginally increase the level of risk, or in some cases maintain a same level of risk because the risks are uncorrelated or have a low correlation. So in the case of something like bonds, you're not just doubling down on duration risk by using higher and higher yielding bonds. You're taking a different type of risk or introducing a different type of risk into the portfolio, be it options, be it something like pass-through securities. And so by combining those together, you can have a yield portfolio that, whether it's a target yield or just a level of yield that you're comfortable with, which is diversified across either more risky yielding products and lower risky yield products. But there's never been a better time to put these kind of structures together and to have the flexibility and the optionality, no pun intended, in terms of putting that together.
Again, folks, for those that are here for the CE credit, I will email you afterwards. If you want to learn more about GraniteShares' offerings and YieldBoost in particular, GraniteShares.com. Will, any parting thoughts here?
Yeah, I think today's YieldBoost Day, we call it affectionately here at GraniteShares, which means that we publish the distributions on this day, on every Thursday of every week. So YieldBoost funds are all weekly payers, which means that there's a weekly distribution. So today is the date that we publish that distribution. The best way for anybody to get that is to follow GraniteShares on X or a YieldBoost account on X, YieldBoost ETFs. and you'll be delivered that sort of first thing in the morning in terms of the distributions for each fund for that week. And obviously then be able to make a decision as to whether you reinvest for the next week or deploy elsewhere. So YieldBoost ETFs on X, GraniteShares on X, and of course the GraniteShares.com website, just for all information related to the funds.
Appreciate those that joined this podcast/webinar, and hopefully we'll see you all in the next webinar. Thanks, Will. Appreciate it.
Thank you.
Cheers, everybody.